Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets of companies and get ready, because today we are diving deep into Galaxy Payroll Group Limited's latest annual report. And let me tell you, the story it tells is quite a rollercoaster indeed. If you appreciate getting quick insights from tough corporate documents, do me a favor and hit that subscribe button. We also have a Discord community linked in the description below, so come join the conversation. Alright, we're looking at Galaxy Payroll Group Limited's annual report for the fiscal year ending the 30th of June 2025. This is essentially their yearly checkup with the US Securities and Exchange Commission. Let's jump straight into the money. Total revenue for the year ended the 30th of June 2025 was about HKD 27.4 million, which is roughly 3.5 million US dollars. Now, that is a pretty big drop from the previous year, about a 9% decrease. And the bottom line tells an even more dramatic story. The company reported a net loss of about HKD 27.6 million or 3.5 million US dollars for the year ending the 30th of June 2025. That is a swing from a positive net income of about HKD 5.5 million the year before. This is quite a significant loss, and it's mostly due to a big jump in operating expenses, especially in research and development, which jumped to nearly HKD 19 million. Speaking of expenses, their selling general and administrative costs also ballooned. For the year ending the 30th of June 2025, these expenses were over HKD 20.8 million, a massive 130% increase from the previous year. A big part of this jump comes from legal and professional fees, which more than tripled, and staff costs, which more than doubled. This suggests they were dealing with a lot of legal and administrative hurdles. Looking at the balance sheet, their total assets stand at about HKD 39.1 million, or 4.9 million US dollars as of the 30th of June 2025. A large chunk of that, over HKD 32 million, is cash. So while they're reporting a loss, they still have a pretty healthy cash reserve. Their cash balance at the end of the year was over HKD 32 million, representing a significant increase from the previous year. This big jump in cash is largely due to their initial public offering, or IPO, where they raised a substantial amount of money. When we look at their operating activities for the year ending the 30th of June 2025, they actually used HKD 27.7 million, or 3.5 million US dollars, showing cash is flowing out faster than it is coming in from their core business. This negatively impacts their operating cash flow significantly when compared to the previous year, where they had over HKD 6.7 million in cash provided by operating activities. However, on the financing side, things look very different. They had a massive inflow of cash of over HKD 49 million, or 6.2 million US dollars, primarily from their IPO. This IPO cash infusion is what heavily boosted their overall cash position despite the operational losses. Now, let's talk about risks. Galaxy Payroll operates in a complex international landscape, and the report highlights significant uncertainties with the PRC government's political and economic policies. Changes in PRC laws and regulations, which can happen suddenly, could really impact their business. The legal systems in places like China and Hong Kong are also complex, and interpretation of laws can be unpredictable. They specifically mention concerns about China's new data security and personal information protection laws. These regulations could mean significant expenses and major changes to how they operate. The company believes they are currently compliant, but the landscape is always shifting, and any future changes could seriously affect them. Then there is the whole issue with auditors being inspected by the PCAOB, the Public Company Accounting Oversight Board. If auditors aren't fully inspected for a certain period, it could lead to stocks being delisted from US exchanges. While their current auditors are subject to inspection, this is a significant risk factor for many companies operating in China. They flag risks related to currency exchange rates, especially between the Hong Kong dollar and the US dollar. While the Hong Kong dollar is currently pegged to the US dollar, any significant changes could impact their costs and revenues when reported in US dollars. Back to business operations, a major concern is their concentrated customer base. For the year ending the 30th of June 2025, their top 5 customers accounted for about 66.7% of their revenue. Losing even one of these major clients could hit them hard. Their IT systems are another point of risk. Handling so much personal data makes them a target, and any data breach could damage their reputation and lead to legal issues and penalties. This is a big one. The report explicitly states that they have material weaknesses in their internal controls over financial reporting. This means there is a reasonable chance that a significant mistake in their financial statements might go undetected. They've identified specific issues related to a lack of accounting personnel and general controls. Let's look at their history. The company was incorporated in the British Virgin Islands in August 2021. But its roots go back to 2013 when the founders started the business in Hong Kong. They've since expanded into Macau, Taiwan, and the PRC offering payroll and employment services. Interestingly, the report highlights a NASDAQ deficiency. Notice they received in March 2025 because their stock price dipped below $1 per S-share for a period. They were given time to regain compliance, and thankfully, by September 2025, they did regain compliance. This shows the volatility they've experienced in the stock market. A key event in early 2025 was the reclassification of their ordinary shares into Class A and Class B shares. This is common for companies wanting to maintain control with founder shares having more voting power. The Class B shares have 50 votes per S-share, giving significant control to those holders. Their core business remains providing payroll outsourcing and employment services to clients, mainly multinational companies, through channels and directly. They pride themselves on a reputable service with well-established client relationships and an experienced management team. Their strategy focuses on expanding in the PRC, strengthening their service capacity in Hong Kong, developing more direct end user marketing, and enhancing their IT systems. They plan to use the proceeds from their IPO to achieve these goals. Looking at their customer breakdown, a significant portion of their revenue comes from a small number of clients, especially those referred by channels for the year ending the 30th of June 2025. Direct end users accounted for about 34% of revenue, while indirect end users referred by channels made up the rest. They rely on in-country partners, especially for services in the PRC. Their major partner, China Key HR Outsourcing Company Limited, handles a significant portion of their PRC operations. This reliance, however, is also a risk if this partner's services deteriorate. The report also touches on the impact of COVID-19, stating that while they implemented work from home measures, their services largely continued without major disruption and client relationships remained strong. Now, the auditor's report Guangdong Proudon CPA's GP issued an unqualified opinion on the consolidated financial statements for the year ending the 30th of June 2025. This means they believe the financial statements fairly represent the company's financial position. However, remember, this opinion is separate from the company's own assessment of its internal controls. Let's revisit the balance sheet. As of the 30th of June 2025, total assets were over HKD 39 million, with cash making up a massive chunk of that. On the liabilities side, current liabilities were about HKD 11.7 million, a decrease from the previous year, showing some improvement in managing short-term obligations. The income statement really highlights the challenges. The net loss of HKD 27.6 million for 2025 is the big headline, driven by those increased operating expenses and the new research and development costs. The cash flow statement shows that while their operations are consuming cash, their financing activities, boosted by the IPO, provided a significant inflow, resulting in a healthy end-of-year cash balance. Diving into the notes, we see the details behind the numbers. The company's use of estimates, especially for provisions for credit losses, is crucial. The adoption of new accounting standards for credit losses highlights the focus on potential uncollectible accounts. So what is the story here? Galaxy Payroll Group Limited clearly went through a period of intense investment in 2025, especially in R&D, which led to a significant net loss. Despite this, they managed to secure substantial funding through their IPO and maintain a healthy cash position. The concentration of their customer base and the ongoing complexities of operating in diverse regulatory environments, particularly China, remain key risks. Their internal control weaknesses are also a significant concern that needs active management. The company is clearly navigating a challenging but potentially high growth phase, with their future success heavily dependent on effectively managing these risks and capitalizing on their expansion strategies, especially in the PRC market. That is our breakdown of Galaxy Payroll Group Limited's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.